For decades, the advice for the American worker remained the same. Contribute to your 401k every month, and a comfortable retirement is guaranteed. But millions of people are now reaching their 60s only to discover that the math of retirement has become shockingly unpredictable. In previous generations, the risk of retirement was managed by institutions. Employers provided guaranteed pensions, funding your lifestyle for as long as you lived. That era ended as the workforce digitized, and companies looked to move liabilities off their books. The pension was replaced by the 401k, shifting the entire weight of financial planning from the company to the individual. Technically, a 401k is a tax-advantaged container provided by your employer. They offer a menu of investments, and in many cases a matching contribution, that serves as a powerful incentive to save. But while the tool is useful, the fundamental guarantee is gone. Your employer is no longer promising an income. They are simply helping you invest. The ultimate risk of a market downturn now belongs entirely to you. Most people operate under the assumption that a 401k balance will grow in a straight, predictable line until the day they stop working. This chart shows how markets actually behave. The 30-year trajectory might be upward, but if the market suddenly drops right before retirement, the impact is devastating. This is sequence of returns risk, a market crash occurring exactly when you must start withdrawing money for bills. If the market loses 20% of its value while you are still working, you can wait for it to recover. But if that loss happens the year you retire, you are forced to sell shares at their lowest point just to survive, permanently depleting your nest egg. Relying on a single account without a plan for market timing means your future security is dictated by the luck of the calendar rather than the amount you actually saved. For many investors, hitting a $1 million balance represents the ultimate finish line, the point where financial security feels permanent. But over a 20-year retirement, inflation aggressively erodes the purchasing power of those dollars. Every year, the cost of housing, utilities, and essential healthcare services moves higher. This is the daily reality of inflation. If the cost of basic goods grows faster than your portfolio, your $1 million buys less every single month you are in retirement. Beyond the rising cost of living, a second invisible force is waiting to claim a portion of that million-dollar balance: the IRS. Traditional 401k contributions are tax-deferred, not tax-free. When you take that money out to live on, it's taxed as ordinary income, meaning a significant slice of your headline balance already belongs to the government. Maintaining your quality of life requires a final balance that mathematically outpaces the combined pressure of rising costs and future tax obligations. Retirees who successfully navigate these financial risks use the 401k as one foundational layer within a much larger multi-account strategy. This starts with active asset allocation. As you approach retirement, shifting your portfolio into more conservative, stable investments protects against a sudden market drop. Investors also build distinct money buckets, including taxable accounts, Roth IRAs, and emergency savings. This variety allows you to choose where your income comes from each year. If the stock market is down, you can draw from cash or bonds instead of selling equities at a loss, significantly reducing your stress and protecting your long-term wealth. The 401k remains an incredible tool for building wealth over time, especially when you start early and maximize your employer's match. But true retirement security is built on active risk management and preparation, not on the hope that a single account will be enough to cover every future cost. Look closely at your current path and ask yourself, is your 401k truly enough to survive the future?